columnist with Bloomberg Opinion. I'm here with Kathryn Rooney Vera. She's chief market strategist at StoneX, as well as my colleague Allison Schrager, Bloomberg Opinion columnist. She's over at the Manhattan Institute and author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. It's the first Fed decision with Kevin Warsh at the helm. So we're eager to dissect the signals in the summary of economic projections, which we'll get soon. We're eager to tee up his first press conference. Will it be the first of many? Will it be the first of very, very few? All very interesting questions going forward here. Kathryn Rooney Vera, what are you most listening for in this debut performance from Chair Warsh?
Thanks, John. I think what I'm particularly keen on is directional guidance with regard to transparency. This is a Fed that has really been very open, and I'd love to hear what regime change means for Chair Warsh. How big is it going to be? How much can he do? I think at a minimum, what we're expecting is the dots to go away. But so this might be one of the last times that we see the dots, would be my suspicion. And also, I want to see how severe does he think the inflation problem is? I mean, this is a guy that was put into the position by, expecting to cut rates. The president wants rate cuts. And now the Fed is openly talking about rate hikes. So that's going to be a problem, and I wonder how he faces it.
Yeah, Allison, what do you think of all of that? I sort of thought I knew Kevin Warsh as a guy with maybe hawkish tendencies prior to the Fed Chair beauty contest. It seemed to me like his inclinations changed when he was a major candidate for this job. Which Kevin Warsh do you think we'll get, and what should we look out for?
I think we're going to get a very careful one. I think he's just, going to hold steady because on the one hand, he would like, maybe, I don't know him personally, maybe he would like to please Trump. On the other hand, he knows this is sort of setting the tone for his term, however long it is. And so if he does cut rates now when, inflation is still like kind of hot, it would really be sending a very poor signal that would make his job much harder. It would effectively signal that he is not serious about inflation. It would signal he's a toady to the president. So I don't think he's going to do that. In fact, now more people are hikes. So I've also heard about him that he's already thinking a lot about his legacy. He wants to go down as a great Fed chairman. So if that's the case, then, great. I think a great Fed chairman. I think a chairman who bucked what the president wanted or what the popular people wanted. And they really sort of did what was right for the economy in the long term. So if he also thinks that, then, we could be getting a sort of a very hawkish Fed president. So I'm super excited for this. Just because new regime, I like new. I'm also just excited as an economist who was, raised in the era of, inflation targeting, forward guidance, transparency, credibility. And we did this. We got a bunch of academics in charge. They did all those things. I was excited to do those things. I thought they were the right thing to do. And now I'm not so sure. So it'll be interesting to see if the experiment ends and sort of how it's judged by history.
Okay, the experiment with ending the experiment. You're absolutely right. To add some context, my entire professional career has basically been in the age of transparency. It was really ushered in earnest by Bernanke, who brought in the SEP in 2007. He made press conferences a regular thing. Powell doubled the number of press conferences, and now we do this every time around. And so it's very different from the smoke signals of central banking past. And in making these changes, they've really ushered in a new era of central banking globally. And if we are on the verge of a sea change, that would certainly make today a very big day, whichever side of the debate you happen to be on. So we're just waiting for the decision to populate in just a few moments. We're looking at the Fed likely to stay on hold, and they do. So the FOMC rate decision, they stay on hold at 3.5% to 3.75%. Take a quick look at the dots. So you see, it looks like the current year dot being revised up a little bit to, this is the median dot. Okay, remember, this is not a consensus decision. This is a survey of policymakers. The median dot lands at 3.75%. The median dot for next year is a little bit higher at 3.625%. The median dot for 2 years out is a little bit higher at 3.375%. But then, for those R-star watchers out there who are stroking their chins, wondering what is neutral in all of this, maybe it's just a little bit of a quirk in the survey, but the long run dot actually steps down a little bit. I want to bring you a few more headlines here. If you'll all just bear with me for a second. Let's see if I can find my place, because I am a guy who likes many windows open. Okay, so here are your headlines as they're populating. The Fed holds the benchmark rate. As I told you, 9 of 18 FOMC participants pencil in a 2026 rate hike. Very interesting. Doesn't seem like that was priced. The Fed removes statement reference to additional rate adjustments. The Fed says the committee will deliver price stability. I see Chris Anstey commenting in the Bloomberg News live blog on this. He says, I'm not sure that most Fed watchers thought there would be 9 policymakers favoring a hike here, right? If you look around the world, we see the ECB tightening recently. We see expectations that the BOA would potentially tighten. The Fed was potentially expected to tighten least of the group. Kathryn Rooney Vera, let me send it back to you. Is this a hawkish constellation of data points that we're taking in right now?
It is hawkish, and I have to emphasize that this is not a one-man show. So, of course, it's a committee, so you would need to get a majority in favor of moving the rate up or down. So, Chair Warsh can't move it of his own discretion. So he would need to get a pretty hawkishly bent FOMC committee on board with a rate cut, if he even really desired for one. I think that, as you say, the constellation of factors, even economically, indicate that we are not in a place to cut rates right now. And in fact, I would argue, and have since the beginning of the year, that the economy is so robust in nature, or let's call it at least resilient enough in nature, with the labor market still pretty good, that it would run the risk of the Fed hiking this year. And, now we're all talking about it, and nine members of the committee also are talking about it. So yes, this is hawkish, and I think that the markets are going to even more aggressively price in rate hikes for this year. The markets are already pricing in one rate hike by December. We're going to get more of that. And maybe I'll just add one more thing, John, which is that my team member, John Hilsenrath, does this survey where he surveys 32 former Fed voting members. And in his last survey, 1 week ago, 17 of the 32 were in favor of rate hikes, and the average expectation was for 50 basis points in hikes this year. Okay, wow. And then there was only one former Fed member that was in favor of rate cuts. The remainder were on hold, but the majority of them were expecting 50 basis points in hikes. I think that this is a Fed that follows the markets. I think the markets are going to price that in, and the Fed will follow suit.
Hey, let me real quick give you guys a little bit more information. This is just the update to the Fed's statement, and look at all that blue and red ink. There have been a lot of changes to this statement. It almost looks like a draft of one of my columns. Woo! Yeah. I'm just kidding. I require no edits whatsoever. Am I kidding? So here's what it here's what it looks like here. So just to read through this, the committee decided to maintain the target rate for the federal funds rate at 3.5 to 3.75% in support of the Federal Reserve's dual mandate. The committee reaffirmed its policy of maintaining ample reserves in the banking system. Okay, just in case you were wondering, because Kevin Warsh happens to be associated with smaller balance sheets. Remains to be seen what he'll actually do about that in the medium term. They go on to say economic activity is expanding at a solid pace, despite elevated uncertainty that owes, in part, to the conflict in the Middle East. Productivity growth and capital investment are strong. That's interesting. That's interesting to me, because I think we've heard Kevin Warsh lay out some arguments about what AI specifically and productivity in general might mean to the Fed's path ahead. So this productivity language, which wasn't there previously, as you can see in this mock-up. Interesting that we're starting to lean on that. Job gains have kept pace with the workforce, and the unemployment rate has changed little. It says here. So it's an interesting read on the labor force. I just want to contextualize that a little bit. The past 3 months, the average of payroll gains have been, you might say, pretty strong. But the bottom line at the end of the day is the unemployment rate is going nowhere. So is this the kind of equilibrium that central bankers really hope for? Is it something that they need to guard against overheating? It seems like the read right now is equilibrium. Not too bad. Inflation remains elevated relative to the committee's 2% goal, in part reflecting supply shocks that have driven price increases in certain sectors, including energy. The committee will deliver price stability. I don't know, Allison Schrager. This is, of course, a committee, but this certainly feels like it has Kevin Warsh written on parts of it to me. What do you think?
He's definitely not trying to cause a splash here. I mean, effectively, I find it kind of a little inconsistent. It's like, they're taking a slightly more, hawkish stance, yet they're also not laying out a case why to me. I mean, they seem to be suggesting that there's a supply shock, yet they're also suggesting that economic activity is hot. So, what is it? What is the justification for a rate cut then? A rate increase then? Because usually it would have a rate increase, not because you think that you're going to bring oil prices down, but because you think demand is hot. And they seem
I think Allison, that's what they're saying, right? They're saying that economic activity is strong. If I'm hearing,
I'm not getting that. Yeah. Like, it's sort of, I don't know. It's sort of like, as well. And even looking at these projections, they're a little all over the place. They expect unemployment to go down, yet they also are expecting, or to stay the same, yet they're also expecting rate increases. I think they're just sort of, I feel like he's just sort of throwing out some things to not rattle markets, but not really saying much of anything at all, which I guess maybe is Alan Greenspan-like.
It is very Alan Greenspan-like. I mean, we've heard a few people make reference to the Greenspan years, including Kevin Hassett, who was in the running for this job, and the argument, which I think some of the nuance sometimes gets lost in this, but the argument, which is true in broad strokes, is that Greenspan didn't really hike a lot when the economy was doing very well in the 1990s, because he thought productivity and some other things would make that possible, and so there are some comparisons made between that era and this era, and the thinking is that productivity may do some things to the neutral rate, but on the other hand, it may be disinflationary. And so maybe we can just sort of sit here and wait and see what happens. Do you think that? Do you read that into this statement here, Allison?
Yeah, it's just sort of inscrutable. which I welcome.
Which is another Greenspanian thing, right?
Yeah.
It's the 90s all over again. I'm going to go watch some Seinfeld reruns.
Yeah, I mean, maybe we can just talk about other things on our live stream rather than trying to sort of parse the language. Or maybe we'll have more fun parsing the language because it'll be less clear. So I guess in that way, it is a move. Although for now, certainly, as you said, I think it's interesting that, they're sticking with ample reserves. They're not even sort of, mentioning that they're going to slow the reversal of QT. So this seems, I guess what we expected, which, nothing, sort of like some hints that this is going to be a less transparent Fed, but also we're not changing anything just now. We also sort of see them also in these long-term projections expecting inflation to go back to 2%, which, maybe. But that has seemed like a sad fantasy for a long time.
Yeah. Kathryn, I want to throw out a theory here. Like, this almost feels like a negotiated constellation of information, because you come out with the summary of economic projections, which is pretty clearly more hawkish than what, the futures and the swaps market had been expecting. Then you come out with this statement, or rather simultaneously you come out with this statement. It almost feels like the new chair is saying, we're sending one signal with this thing, like let me compensate with this other thing, so that the market doesn't come away with an unduly hawkish message, and we all sort of get our piece. What do you think of my theory?
Maybe, but I'm kind of more back to basics type of person. When I look at the statement, to me, it's just recalibrating to reality. I mean, productivity is a reality. It's happening. Capital investment is strong, so those additions are not opinions; they're facts. Economic activity is expanding at a solid pace. Productivity growth and capital investment are strong. Job gains kept pace of the workforce. All of this to me is truth. So the economy is growing. Unemployment is still very low, below the NAIRU. I find it refreshing. I'm excited for a change of the guard. I think we've gotten a lot wrong. I think the constant transitory posturing is debunked and stale. And I think old habits are hard to break unless you have a change of the guard. And this is something I was talking about with my head of rates. Like the dot spot, for example, in my world, talking to institutional clients, it's just like laughable. So, when we have forward guidance, the dots, SEP, and you had mentioned this, John, that were born in 2012. And even before that, Bernanke introduced them. I mean, this tool served a purpose back then, but the Fed has gotten so many things wrong, so much and so egregiously wrong, that now it's, I would say, counterproductive and if not embarrassing. So I think that this is great. I think that it's fantastic that the Fed wants to step away from the headlines. I hope regime change comes in the form of less talking. It's a different world than Greenspan, for sure. I love, there's this one quote, I was looking it up, and Greenspan he once said to a lawmaker, "If I seem unduly clear to you, you must have misunderstood what I said." So that, I think, is what Warsh wants to be like. And there may be some credence to that. I do think that we're in a different world than in the Greenspan time, and you had quipped about, the 1990s all over again. But this is very different. Like in the 1990s, and I know you were joking, but like you had the collapse of the Soviet Union, you had a peace dividend from Soviet collapse, you had the advance of globalization, real productivity gains from the internet, no budget deficits. We have all of the opposite. The only thing I would change, I would say that is similar, is the beginnings of productivity. Like we have 1.8% to 2.2% productivity gains. That's great. But I don't think the AI phenomena is baked into those numbers quite yet. So I do buy into the argument that over time, productivity will chip away at inflation. But I think that the statement is dead on in the sense that the U.S. economy is growing at potential, at trend. Unemployment is too low. The fiscal deficit is 6%. You have demand pull inflation and you have supply inflation from food and prices that are second order effects that are in the pipeline, no matter how soon the Strait of Hormuz opens. So So interest rate hikes make sense to me. And I don't think that Warsh is a Trump patsy. I think that he is a serious economist that cares about his legacy, and I bet he'll do what he needs to do in conjunction with the committee, since this is driven by committee, and you rarely have a Fed chair that goes against the grain in terms of consensus.
Yeah. So let me dig into the transparency thing a little bit more, because the way I see it, like, there is, transparency as a virtue unto itself, where you say the Fed is a super powerful institution operating in a democracy that is the United States of America, and it has a duty to the American public, like, not to operate behind the shadows. And by the way, it also has to worry about PR a little bit, because if the American public sees it as this shadowy thing, like, it loses authority and potentially loses its mandate for independence. So that's a reason in and of itself to want to be transparent. And I think that that's always been at least 50% of the argument since the transparency revolution started in earnest, really in like the 1990s, when they first started publishing actual rate decisions, but then continuing with Bernanke and sort of reaching its pinnacle under Powell, you could argue, when he took the press conferences to every single meeting. The other side of the coin, which is where I think we can have an interesting debate that you both have introduced points on, is transparency and forward guidance sometimes get muddled a little bit. And forward guidance was sort of explicitly introduced as a tool in the zero lower bound era as a way of conducting monetary policy. And it was explicitly for that argument. And in a world where inflation is stubbornly hovering around 3, now actually 4%, and it feels like the risks to policy rates is actually to the upside, maybe we don't need to use that forward guidance tool as much. But shouldn't we still keep it in our back pocket anyway, Allison Schrager?
Well, did it ever work? I mean,
yeah, it worked
really.
insofar as it.
We never, everyone is like, wow, we haven't reached our inflation target because we've been above inflation, but before we were below inflation. We've never hit the target. And the goal was, the hope was that the forward guidance would also sort of compensate for this low zero rates and give the economy a boost. And arguably it didn't do that either. And if anything, as Rich Clardo maintains, that's what boxed the Fed in 2021, 2022 from raising rates sooner. Because, we sort of just tried this experiment where what the Fed said was a policy tool as strong as actually, cutting rates, increasing rates, or doing QE. And the idea that expectations were arguably more powerful. So I think what we're seeing is the problem with the transparency is they're too transparent, and it became clear that they know as little as the rest of us about what the future holds.
Yeah, they were wrong so many times. It shot credibility. I agree with Allison, John, and I think the addition. Sorry, go ahead.
So that tool didn't become as powerful. And then I said the forward guidance ended up hamstringing them. So, I just was seeing like an old reminder that Bernanke argued that, forward guidance and transparency would keep long-term rates lower because you would have a lower term premium by lowering risk and have more transparency. So I guess now we'll see if that's true. Sorry, you were saying something interesting, Kathryn.
Oh, no, not at all. And I'm sorry to interrupt you. But I agree with you. And I think that, this idea of owing it to the American people, John, to be communicative. I think the Fed owes it to the American people to nail its dual mandate and nothing else. So call me what do they call that in the Constitution? Like a strict interpretation of the Constitution. I'm a strict type of interpretation type of gal. And I think that the Fed owes it to the American people to get it right. And I think they've gotten it wrong at many passes, and they've taken severe hits in credibility. So I think less communication doesn't mean necessarily that the Fed is doing something clandestine or shady or like operating in the shadows. I think it's about accountability. Explain the decision, explain the data, explain the reaction function to make the decision. It doesn't owe the markets a high frequency forecast service that gets it wrong and turns it every week into 3 different members saying different things. And more words, I think, can create less clarity. And I think that is effectively what has occurred. So I'll reiterate, I think that Kevin Warsh is what his regime change is ushering in a more laissez-faire, like get out of the markets, remove the Fed's heavy hand in the markets. Let's just take a back seat. And when I was in this conference 3 years ago, John, where I heard him speak and I met him afterwards, and he said, I define success by the Fed it as such that when you're no longer talking about us, when we're not moving the markets, when we're not in the headlines, and you guys aren't like, waiting on the edge of your seats for the next thing that comes out of our mouths. And I think that's the right way to go. And let's see how it pans out. I mean, ultimately, it's a committee. And ultimately, I do think that there's going to be tweaks at the edges. We're not talking about, selling off all the mortgages and treasuries. What we're talking about is no more dots, maybe less Fed speak, kind of like more being a little bit quieter. And I think that could translate into some volatility at the beginning of the markets, because every Fed chair the markets test. And so I think we should expect that as well. But in the net, I think that less communication is actually going to be favorable for the markets and for everyone.
So one or two more points on the communication point. So I hear you, but a point that I often hear, this is the Clarida point that Allison points out, is that, well, the Fed made erroneous forecasts in 2021, and then they were bullheaded and they didn't want to sort of change their mind in public, so that made them slow to react. First of all, we know that the Fed wasn't wrong in getting the call wrong in 2021. They were in line with the consensus, which turned out to be unfortunate. Also, is the fact that they often get things wrong, which I think is kind of true of all forecasting, it's just like perilous business, right? Is the fact that they sometimes maybe often get things wrong a reason not to tell us? So we know, we've established that we think they have this behavioral bias. Why don't they just do the right thing and try not to have the behavioral bias? Try not to be so bullheaded about the whole thing.
I would say they're bullheaded. I mean, I don't think their forecasts are worse than anyone else's. It's just like, as Kathryn points out, there's a million forecasts in the world. Why do they have to be one of many? And, Richard would say it's not that their forecasts were wrong, it's that they committed to policy based on their forecasts, and then they refused to reverse course on the policy they committed to. It's fine to say, okay, we said we would not increase interest rates until employment got to here. And then we had inflation take way off and unemployment still hadn't gotten to where they wanted to be, but it was so they also decided to put more of a weight on unemployment over inflation, which turned out to be wrong. So it's like, they put out these numbers and they say, we're going to do this policy based on these numbers. And it ends up just instead showing it's not that they're worse at it than anyone else. They're just as bad as all of us. But we expect the Fed to be better. And
I agree.
To reveal that they're not.
I agree with Allison. I'll add to it that the reason I think it's more important and how we can differentiate the Fed from other forecasters is that the Fed is the monetary policy authority setting the rates. So yeah, they're different from us. And so I think that's one thing. I think because they are the be all end all. And I think that has hit the credibility and the bottom line. Private forecasters can miss, and we do miss. But this is the essence of the problem, and the Fed can win back some credibility by doing what they have to do without having all of this noise, and I consider it noise. Where I would like clarity and more transparency is on the personal account trading front. So, but that's another conversation. But that's where I think the Fed can do a much better job with regard to transparency and following the rules of the road. But with regard to policy making, they should do their homework, follow the Greenspan model to some extent. Yes, it's a different world now, but do their homework behind the scenes, come with a decision, tell us what the decision is, explain the decision, and the markets are comfortable with a Fed that has improved its credibility. I think we could all argue and all agree, and I'd like to know if anyone disagrees, that the Fed has had a credibility hit, and a lot of it has to do with errors with regard to communication, with regard to erroneous forecasts, with regard to decisions, and with regard to experiments that really are doubtful as to whether or not they were successful.
Yeah, I would just to be diplomatic. I think the position that I'm staking out is I'm not really interested in a Fed that continues to be wrong but is wrong in private. I would prefer for them to be right going forward, and if they could be right and transparent about it, awesome. You know what I mean?
Is there and what is
we all like that?
Yeah, what does less transparency look like for you? Like, I feel like we're talking about all or nothing. Is there a happy medium? Like, do you think we need a presser after every meeting now?
Well, I am predisposed to like the pressers because, Kathryn, as you know, I'm in the business. I'm in the business.
Right.
Sure. But here's one final talking point on this, and I really want to turn to the balance sheet because we only have 3 minutes here. So one thing that I've sort of been a champion of in my column is more scenario analysis, right? This was an idea that was part of the Bernanke report to the Bank of England, and something that they've started to implement. I've been thinking a little bit about how that's going. More on that maybe later, but I like this idea. It seems intellectually honest. It prevents this problem a little bit of seeming like you're wrong all the time. You just be honest with people. We're reacting to events in an uncertain world. If this happens, we'll do this. If this happens, we might do this. If this happens, we might do this. Are you guys fans of scenarios?
I mean, as Kathryn said, we want to know in terms of transparency, we do want to know the reaction function. We don't want to know that they can see the future, and they can't. But I do want to know a reaction function. Like that's a nice thing to commit to, and that's nice transparency.
Kathryn, what about you? Are you a scenario woman?
I am, but I hope the Fed has been honest with us. I mean, I like to think that they have been honest to me. I expect that full-heartedly. So if they haven't been, that's a concern. But I think the presser is going to be very interesting today. I think we're going to know very quickly to what extent Warsh is going to really try to replicate Greenspan's opacity. But let's see, as I think Allison said, the tone of the reporters. I want to hear it. I wonder if they're going to go for the jugular. They think he's a puppet of the president. I want to hear. I'm listening for independence, for balance sheet. We haven't talked about balance sheet, but I think he's going to punt the question about the balance sheet. I think he's going to punt a lot. I think it's probably going to be a boring presser, and I'm looking forward to hearing his thoughts if someone asks him on the neutral rate as well.
Yeah. Well, I never like to keep people too long, so I want to wind down here. But with your parting statements, Kathryn, I want to hear what you want to hear from Chair Warsh about the balance sheet, and then same to you, Allison. If we could do this in like 60 seconds apiece. What do you think, Kathryn? What do you want to hear from Chair Warsh about the balance sheet, and why is it important?
Yeah, I think it's important to know if his intention is to actually bring it lower or continue as is. I mean, you had mentioned something initially about him being hawkish. I don't think he's hawkish. I think he's hawkish against intervention, not hawkish about rates going higher. I think he hates intervention. I think he obviously hated QE. Using it as part of the Fed's toolkit is clearly out the window now. And so I think that's what I'm looking for. Is he actually talking about speeding up the roll-offs or selling? Because I don't think he wants to do that. The housing market is already very complicated. Interest rates are high. Affordability is low. Supply is low. So you don't want to kill that aspect of the economy. And I think the president will give him a new nickname very soon if he starts to do that. I wonder what that nickname could be, but I'm sure it's in the offing very soon. But that's essentially what I'm looking for, John.
Okay, Allison, I got to cut you off because we're done here. But fortunately, we get to hang out a lot, and I'm going to hit you up with a balance sheet question at the very beginning of the next one. Thank you very much for joining us. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion. Thank you to Kathryn Rooney Vera from StoneX. Thank you to Allison Schrager, and enjoy Kevin Warsh's very first press appearance.
Thanks, John. Thanks, Allison.